Hi, I'm Sean Pinder from the Department of Finance. In the following short presentation, I'd like to discuss with you an important decision facing many different investors, the risk management decision. A lot of our discussion in this session is going to focus on risk management from a company's point of view, but almost all of the points we make are also directly relatable back to an individual investor's decision about managing risk. Now, before going through some specific strategies that might be employed to manage the risk of an organisation, let's firstly consider how a well-run organisation might approach the risk management decision. So the first point to make is that in a well-functioning organisation, we have the owners of the firm, the shareholders, represented by an active and inquiring board of directors. It is the role of the board of directors to firstly understand the risk appetite of the owners of the company, and to then set an appropriate strategy that matches that risk appetite. Having set the strategy, the board of directors should then turn over responsibility for its implementation to the company's senior management team, headed by the Chief Executive Officer, the CEO, and the Chief Financial Officer, the CFO. The board will then monitor and review the performance of both the management team and the strategy itself, and modifications will be made as time goes on. Now, a key point to make here is that the purpose of risk management is rarely to remove all risk from a business. If the owners of a firm truly wanted to invest in risk-free assets, then they would have put their money into government bonds and also saved themselves paying the salaries and allowances of the managers and directors. No, the true objective of effective risk management is to identify the source of risk within the organisation and then try to adjust the company's exposure to suit the risk appetite of the company's shareholders. So the next question is, what specific risk management strategies can a company implement? Well, the first way we'll discuss risk management is how it might be naturally integrated into the other decisions that managers make on a day-to-day basis. Take, for example, the investment decision. That is, which assets should the company invest in? The risk management strategy set by the board of directors will often inform this decision. For example, the firm may have a policy not to enter certain markets overseas because of the perceived level of risk in those markets. The risk that the company might be seeking to avoid might be related to the presence of highly volatile exchange rate movements, or the underlying business conditions in the market, or alternatively, the level of political risk and social upheaval present in the market, which may mean that any overseas staff might be in physical danger, or that it might be difficult to bring cash back from the foreign operations. Now, shifting our focus to the financing decision. We can see that some of our financing decisions are very clearly impacted by the risk strategies of the firm. For example, a firm looking to reduce uncertainty associated with its cash flows may look to lock in an interest rate by using fixed rate debt as opposed to variable rate debt, so that they're certain as to their interest charges in future years. A related issue is the matching of the period of a loan with the life of an asset. During the global financial crisis, we saw that a lot of firms got into trouble because they were using short-term loans to fund long-term assets, in the mistaken belief that they'd be able to refinance their short-term loans as they expired. When the global financial crisis hit, a lot of corporations were surprised to find that no one wanted to lend to them, as global credit markets were paralysed with fear, and many firms were then forced to either sell off assets or refinance by taking new owners into the company to replace debt that could not be reborrowed. A popular risk management strategy for firms establishing operations overseas is to take advantage of what's known as a natural hedge. To illustrate, let's consider a company that raises funds for overseas expansion using loans raised in Australia in Australian dollars. Now, what happens if the foreign currency depreciates in value? The value of that asset, in its Australian dollars equivalent, will fall, while the value of the loan is unaffected. So this will create a loss in the books of the Australian company. An effective low-cost strategy for the company is to purchase the foreign asset using funds raised from debt issues in the foreign currency itself. The result is that the value of both the asset and the loan will rise and fall together as the value of the foreign currency appreciates or depreciates in value. So, there are just a couple of examples of how firms might integrate risk management policies into their day-to-day activities. Another way that firms might manage risk is by taking a position in a derivative contract to offset some of the risk created in their business. A derivative contract, or a derivative security, can be defined as an asset whose value is based upon, that is, derived from, the value of some other asset. Now, whilst there are literally hundreds or thousands of different types of derivatives traded in the market, for illustrative purposes, let's restrict our discussion today to two of the main styles: forward contracts, which can be used to lock in a future price, and option contracts, which can be used to set a maximum or minimum price at which to trade in the future. So let's set this up with an example. Let's say that you are the CEO of a huge company that runs hundreds of wheat farms throughout Australia. The risk that the farmer faces, of course, is that the price of wheat, which as we can see in the graph on the right here is highly volatile, that price may decline between the period of time that it is sown in the paddocks late in autumn and when it is harvested at the end of spring. So, to overcome this uncertainty, you might enter into a forward contract that locks in the price that you'll receive for your wheat. Let's say the price you lock in, which we call the forward price, is equal to $170 per metric tonne. This vertical axis on the graph indicates the price that you'll receive for your wheat per metric tonne, whilst the horizontal axis displays the market price of wheat at the time that you're ready to sell it. The orange line shows that if you don't adjust your risk, you'll simply receive whatever the market price is at the time. So if the market price is $100 per tonne, you'll receive $100. If the market price is $300 per tonne, you'll receive $300. In contrast, the forward contract locks in a price that you'll receive, in this case at $170 per tonne, as represented by the green line. So irrespective of the market price, you know that you'll receive $170 per tonne. You have eliminated all uncertainty about the price you will receive. So the good news is that if prices are less than $170, you'll still get $170. On the other hand, the bad news is that if prices are greater than $170 per tonne, you'll not be able to enjoy the higher prices because you have agreed to sell at the locked-in price of $170 per tonne. This is a key characteristic of risk management using forward contracts. They involve giving up the upside associated with favourable price movements in order to remove the downside associated with adverse price movements. This give and take aspect of forward contracts makes them a relatively cheap way of hedging price risk. But what if you wanted to remove the downside whilst keeping the upside intact? Well, now you need a different sort of instrument that acts as insurance against an adverse outcome. Those instruments are known as options contracts. The way that an option contract works is that it entitles the person that owns the contract to enforce a price only if they choose to do so. So in our example, let's say that you set a minimum price for your wheat at $170 per tonne. Now you have the right, but not the obligation, to receive $170 per tonne for your wheat. Now what this means in practical terms is that if the market price for wheat is less than $170, then you will enforce the option contract and receive $170. If, however, the market price for wheat is greater than $170, then you will allow your option contract to lapse and simply sell your wheat on the market at the higher price. So an option contract allows you to take advantage of price movements that are in your favour while setting a minimum price that you'll receive for your wheat. The option contract provides you with insurance. That is, it guarantees that you will not receive less than $170 per tonne, no matter what the price is in the future. But as with any insurance, you'll have to pay an insurance premium for this coverage. So there's two examples out of hundreds of varieties of derivative contracts. These contracts aren't only used to manage commodity price risk, as demonstrated in this example, but to also manage things like interest rate risk, foreign exchange risk, and even risk related to adverse weather events, such as hurricanes. In this presentation, we have introduced you to some of the central ideas that well-run organisations must face when making the risk management decision. We highlighted that the objective of risk management is rarely to eliminate all risk, but rather to reduce risk to a level acceptable by the organisation's owners, its shareholders. The strategies that the Board of Directors arrive at are then implemented by the management team led by the CEO and the CFO, often dictating the way in which the company does business on a day-to-day basis. We also discussed the way in which two specific derivative securities, the forward contract and the option contract, might be used to manage risk.